what we're going to be going over here is governmental accounting for an investment trust fund. Now, an investment trust fund, that's part of the fiduciary funds here that the government will be accounting for here. And those fiduciary funds, those would be private purpose trust funds, the investment trust fund that we're going to be looking at here, also pension trust funds and agency funds. Now, when we're talking about the pension trust fund, this is where a government unit here is going to act as a trustee or an agent here for some external participants here. They're going to pool their investments here, and then the governmental unit here is going to manage those investments here in this investment trust fund. Okay, so the investment trust fund, now the key points here is that first, it accepts assets that are invested to produce earnings for external participants. This is going to be a government managed investment pool essentially here. And secondly, the proper accounting, they have to do proper accounting for gains and losses here on those investments, whether realized through the sale of the investment or unrealized through appreciation or depreciation of the asset's fair value. It's really necessary for the preservation of the trust fund. So you're going to record the assets at their fair value when they're purchased here, and then you're going to make adjustments to those to your assets here based on what their fair value is at the time. Okay, and thirdly here, the measurement is focused on full accrual accounting procedures. We don't use modified accrual, we use full accrual accounting here for the investment trust fund. And fourthly here, you must separate between the principal items here and revenue items when you're talking about these trust funds. And a common method is really to set up two different funds here. So first off, for our principal items, this is where we want to protect the principal here on this investment trust fund. And then secondly here, we have the revenue or the earnings. This is the dollars that can be distributed here to the external participants here. So first, looking at our principal items here, just looking at in an endowment principal fund here, this is where you're going to be looking at your additions or contributions here in the principal fund. And what you want to record here is the principal amount of the investment. Just showing it here, I had example here, $200,000 as the contributions to this investment trust fund as the principal amount here. So that's the investment. And then breaking out our revenues here, those would be additions to the revenues in this for our principal items, and those would be the revenues that are generated off the principal investment here. So just looking at our case here, additions, we say for the year here we had $15,000 worth of revenues generated off the $200,000 principal. So we debit our additions to our revenues here for $15,000. That represents the earnings here in the principal fund here. Now, those earnings here, we can transfer, that's what we can transfer out here. And this is what we're going to transfer out to our earnings fund here. So say, for example, those $15,000 worth of earnings here, credited, 15,000 here, transfer them out here, and then they would go in as additions to the interfund operating transfers to the earnings fund. So that's going to be the transfer in to our earnings fund here. So here we debit our additions here to for the interfund operating transfers for $15,000. That's for the transfer in. So we transferred out from the principal fund here. The earnings that were generated in the principal fund, we transferred them to the earnings fund here, that $15,000. And then when you actually distribute any earnings here, then you'd credit or reduce your additions to the interfund operating transfers here for $15,000. That's where you'd be distributing your earnings to the participants here. So the source of assets here for our endowment, our earnings fund here, are really coming off what you're generating off your principal investment here. That would be really the only source of assets coming into your earnings fund here. So let's go up and let's look at a basic example here. Okay, now let's look at the investment trust fund here. This is the case here where we'll use for our example here, government participants here in this trust fund are going to invest $100,000 here. And what this trust fund is going to do here, managed by the government, for our example, they're going to purchase some bond here, purchase a bond at a premium. So they're going to purchase a $100,000 bond here. It has a $94,000 face value as a 10-year bond here. So just looking at what we have to do here, we'll have the $100,000 investment here, $94,000 face value, so we have that $6,000 bond premium. It's a 10-year bond. So what we're going to do, we'll just, for our example here, we're going to amortize $600 a year here on this bond premium. And that's really going to become our fair value adjustment for this example. Okay, so again, what we're going to do here, we're going to separate our principal from the revenue or earnings. And what you have to do here when you're using these investment trust funds, just use full normal accrual accounting. Okay, so let's go look at our example here. What we're going to have to do is we're going to have to determine our investments here and then our revenues here, and also any unrealized gains or losses here. And also what we want to do is we want to determine what our fund balance is going to maintain a fund balance here in our principal fund account, and then we're also going to be using some of those earnings from that principal here. They're going to be sent to the earnings fund. Okay, so let's start our example here. So they make the investment here. They received, first off, they received the cash here from the participants in this trust fund here. So debit in your principal fund, debit your cash account here for $100,000. I'm showing everything in T account form here. Okay, so debit that for $100,000. Now, that would be recognized as revenues here in the principal fund. So you would be crediting your revenues account here for $100,000. So that's actually this is where the participants are contributing that cash amount. Now, the governmental body government that's managing this trust fund, they're going to turn around and they're going to purchase those bonds here at their face value here. So they purchase the bonds, credit or reduce their cash here by $100,000, and then in their investments account here, it could be investments under bonds, but I'm just using the investments account here. Again, in the principal fund, you would debit that here for $100,000, the bond purchase. Okay, so we purchased the bonds here, used some cash, and we recorded that as an investment here in our investments account. Okay, now we come along here, and for the year, let's just say that the investment on that bond generated $7,500 worth of interest. So we debit or increase our cash for the amount that we received here in interest, and then we would go and we'd recognize that as revenues, again in our principal fund here for the interest received, credit that a revenues account here for $7,500. Okay, now we also have to take care of, this is the key point here, when you're dealing with these investment trusts, you have to maintain a record here or make some fair value adjustments. And for our example here, we're dealing with that $600 worth of amortization of that bond premium here. But regardless what you're looking at, you want to maintain or adjust your fair value here in your investments. So for our example, we had that $600 amortization per year here because we're purchased the bond. It has a $94,000 face value, but we bought it at $100,000. So we paid more for it than what we're going to have. We had to pay more for that bond than what we're going to receive when it matures here. So that's going to reduce our investments account. So for a fair value adjustment here, credit or reduce your investments account here for $600. And this is where you want to go down. And now you're going to, when you're looking at your investment trust funds, you want to determine any gains or losses here. In this case, it's unrealized loss, again, in our principal fund. So we debit our principal fund here for the unrealized loss of $600. That is the fair value adjustment. So that is, we're really looking in our example here, determining that amortization here, rather than calling it amortization, we're calling it a fair value adjustment here. So that's what you want to look at. Now, remember, if it was purchased at a discount, then we would have had an unrealized gain instead of a loss here. But point is, you have to determine your gains or losses here on the trust fund, and that is what we're looking at. Unrealized loss here for our example. So debited our unrealized loss here for $600. Now that went against, and remember your investments account, because we had that unrealized loss, our investments account here was reduced by the same amount of that unrealized loss here, $600. Now let's just say we had some transfers out here. We're actually going to transfer out for the year here, we're going to transfer out of the $7,500 that's sitting in our cash account. We're only going to transfer out $6,000 here. So, and that's going to go into the earnings fund here that we're going to use here. But could have transferred all of it out, but for our example, just say we transferred out $6,000. So what you would do, credit your cash here for $6,000, and then you're going to move down to your other financing uses here. Again, in your principal fund here, you're going to debit that here for $6,000 because you're going to use this cash here. It's actually going to go to the earnings fund here, but you're going to debit that for $6,000 here. Reduced your cash for $6,000, so you debit your other financing uses here for $6,000. Now comes the end of the year here, and we're going to have to close out. And what we want to do is we want to determine the fund balance that's reserved here in this principal fund here. So let's go and let's look at our accounts that we have to close out. So what we have here in our revenues account, well, we had a credit here of $100,000 for the cash received here from the participants for that investment here, and then it was the interest received here, $7,500. So what we would have, that's a total of $107,500. So we're going to debit or take our revenues and reduce them down to zero here. Close it out down to zero here. $107,500. And that's really going to go into our fund balance reserved here after we do all our closeouts. So close out our revenues. Then we have our unrealized loss. Well, we had a debit here, $600. Now let's just credit that out here for $600. And then the other closeout we have here is our other financing uses here, because that's going to have been used here. So we had a debit here, $6,000. Now we can credit it out here for $6,000. So let's just look at our debits and credits here. So we have revenues here. We had a debit of $107,500, and in our unrealized loss here, we had a credit of, well, let's look at it in these terms. Let's look at all our credits here, determine what our fund balance reserve is. So what we would do here to determine what our fund balance reserve is, we're going to be looking at, okay, let's just start with our $107,500 here in our revenues here. So we're sitting with a debit amount here of $107,500 in our revenue. So let's determine what we're going to need for our credit balance. And what our credit balance is going to go against is our other financing uses. We have $6,000 here that we closed out for our financing uses here, $6,000. And then our unrealized loss, we have a credit here that we closed out for $600. So we're going to need a credit balance. We're going to have a credit balance here in our fund balance reserve account for $100,900. And that's really taking our credit here of $6,000 plus our credit here, unrealized loss here, $6,000, and the credit $100,900 here in our fund balance reserve really nets out against the debit here in our revenues account for $107,500. So really that's how we came up with our fund balance reserved here. So we're sitting for our closeout for the year here, sitting with our fund balance in this principal fund here at $109,000. Now you can see where that is comprised of. So our cash account, if we net everything out here, we have a $1,500 balance here in our cash account, and our investments account, when we net out our loss here, our fair value adjustment for the year here, we're sitting at $99,400. So $99,400 plus our $1,500 here, those debit amounts balance with the fund balance reserve here, a credit of $100,900. So that's our fund balance. So we really could look at our fund balance and really looking at it two ways here versus, and it has to match what's sitting here in our cash account in this case, plus what our fair value adjustment here, what our fair value is sitting in our investments account. And you can see here it worked out both ways, either taking our revenues here and netting those against our unrealized loss and our transfers out. There we come up with our fund balance reserve. Okay, so I just looked at it in the case here where we had these other financing uses here, where we're going to send this $6,000 to the earnings fund here. But rather than, this is what you really have to do when you're talking about government recording these entries here in their governmental accounts. So what we're really going to be looking at here is recording the interfund transfers from these other financing uses here in our cash account down into our earnings fund. So what you want to set up here is, or rather than this other financing uses here, well, let's just look at this transfer out here of the $6,000 from other financing uses and our usage of cash here of $6,000 for the transfer out here. Okay, out from the principal fund. So let's go down in, this is what the entries that you'd actually make in your principal fund. So you'd have your operating transfer out here in your principal fund here, and then you're going to have due to the earnings fund here in your principal fund. So you're going to be transferring out, and we're going to be setting up a liability here in the principal fund. And then what's going to happen here, we're going to make these entries here in our earnings fund. We're going to do from the principal fund here and also other financing sources here. So let's start with our principal fund here. For operating transfers out, debit that here for $6,000, and this is going to set up the liability here. Then our balance, our credit, is going to go to due to the earnings fund here. Again, in our principal fund, this is going to be moving to the earnings fund here. Credit that here for $6,000. So that's really a liability that's set up here in the principal's fund. Now, what goes into the earnings fund here, this is the case here where you're going to put due from the principal's fund. You had due through the earnings fund here in your principal fund. Now you're going to due from the principal's fund here in your earnings fund here. Okay, so we debit our earnings fund here for $6,000, and then our credit is going to go to other financing sources here in our earnings fund. That was a source here. Credit that here for $6,000. So we really had a liability here in our principal fund for the amount that we're transferring to the earnings fund here, and it's a liability until it's transferred to the earnings fund. So now let's say the cash was actually remitted here from the principal fund to the earnings fund. So now you can get rid of your due to the earnings fund, the liability. You had a credit here of $6,000. Now you can debit it or remove it here as a liability, debit it here due to the earnings fund for $6,000. And then this is where now no longer due from the principal, moving down to your earnings fund, you can take and remove that because it's being moved over here. So in your earnings fund, due from the principal fund, you credit it here for $6,000. So you remove that out here. And then also other financing sources. Well, okay. So that's on when the cash is remitted. And then one other thing here, then we'll look at the closeout. In our cash account here, in our earnings fund, when that was remitted here, we would debit that here for $6,000. So really what the credit, if we look up above in the principal fund, the credit would have been to the cash. That was that transfer out in the cash account here in the principal's fund. So that was the debit here in the earnings fund. So when we go back with our remission here again, due to the earnings fund, we would have, on our principal fund, we would have debited that or removed it here, and then we would have had, that was the remitted amount here, and then we also would have had that cash up in our principal's fund. That cash would have transferred out, would have been credited here. So that's really how we got that remission here for our cash. And then in the due from the principal fund and the earnings fund, we would have had removed that here for the credit here for $6,000, and then the other financing uses debited it out here for $6,000. So what we're talking about, after any distributions here of cash distributions from this earnings fund, then you can determine any fund balance sitting in your earnings fund. And any distributions here, cash distributions here from your earnings fund, would be realized as expenditures. So I'm not showing it, but they would be realized as expenditures here. So I didn't want to confuse the issue here, but when you're dealing with those governmental accounting, you're going to have those interfund transfers here. And in our example above here, we use that other financing uses here from the principal fund for cash or remission or cash that's going to be earned or earnings out of the principal fund here that was going down into the earnings fund, and that affected both the other financing uses up above here and those cash accounts. So really just remember these accounts here. So you'll have your in your principal fund, when you make those transfers, you're going to have the account here, other transfers out here, in this case from the principal's fund, and that would have set up your liability here, and then the credit or would be due to the earnings fund, again in your principal fund. So you have a transfer out account here, and then the due to the earnings fund. In this case, the earnings fund is where it's being transferred into. And then in the fund that's receiving it here, you have due from, in this case, the principal's fund, and then you'd also recognize it as other financing sources here from the principal fund, and all those would be recorded in the earnings fund. Okay, so that'll summarize our topic here on investment trust funds, and we looked, that was part of our fiduciary funds. And just remember, it can be a bit complicated here, but when you're talking about those investment trust funds, just use normal full accrual accounting. Don't use any modified accounting, but use full accrual accounting. But remember, when you're making those interfund transfers, they have to be accounted for as I was showing here in this example.